Many medical spa owners deal with lower than expected bank account balances. So if you've ever wondered why it is that your revenues look great, but your bank account balance doesn't match up, it's time to take a deep dive into your finances. I'm Chelsea Zania, owner of Peak Financial Wellness, and we provide profit-focused accounting and consulting services to medical spa owners. And today I'm going to give you 3 common cash flow drains. So the first is overstocked inventory. I've dealt with at least 2 MERS cash crunches this year. These sales people that come in are really smooth, and it's easy to get caught up in some deal that really isn't beneficial for your spa. So just make sure that you're only buying the inventory that you actually need, and you're not committing to buy a bunch of inventory that's going to leave you overstocked in inventory and no cash left in your bank account. So really, if you're in a cash flow crunch, I only want you buying enough inventory to go 30 days out, possibly 60, but really 30 days if you're in a cash flow crunch. The second cash flow drain is high debt or equipment payments. I know that we all want to have the latest and greatest technology, and there's a new laser out and you want to compete with the spa down the street, but new equipment doesn't always equate to increased sales. So we need to make sure, first of all, that our debt payments are never more than 50% of your net profit. So just say, for easy numbers, your net profit is $10,000. Your debt payments should never be more than $5,000. We want to keep them below that, just to make sure that there's enough cash left over to also pay yourself and take an owner's distribution. So debt payments never higher than 50% of net profit that you're generating. And if you are going to invest in a new laser, make sure that you have a marketing plan ahead of time for how you're going to make a return on that investment. And I never advise having or buying a piece of equipment or a new device unless you've already got an established customer base that you can market that device to and upsell them on. So that is the second cash flow drain. The last cash flow drain that I'm going to talk to you about is marketing waste. So spending money on marketing channels that are not bringing you a return on that investment. So to keep that from happening, you want to make sure that you are monitoring your marketing KPIs and keeping up with all of that. You need to know the number of leads per marketing channel. So whether that's social media ads or Google or whatever it is, make sure that you know the number of leads by marketing channel. You understand your client acquisition cost, how much each of those leads is costing you per channel. And lastly, keep an eye on that client lifetime value to make sure that you are not pulling in leads that are not quality leads, and they're for customers that are coming in once and then not returning. So those are 3 major cash flow drains. I hope that this video is helpful. As always, if you need further help, reach out.